With Donald Trump leading the GOP race and campaigning heavily on new economic strategies, one of the biggest proposals making waves in 2025 is his plan to reintroduce sweeping tariffs, including a 60% tariff on Chinese imports and a universal 10% tariff on all global imports. While this might sound like a bold move to protect American industries, the truth is, it could have a significant immediate impact on your personal finances. Let's break it down. The U.S. currently imports over $600 billion worth of goods from China each year, covering everything from smartphones and electronics to clothing, machinery, and furniture. If Trump's tariffs are implemented, companies importing these goods will face much higher costs, and those costs will likely be passed on to you, the consumer. That could drive prices up across multiple sectors, further straining households already dealing with persistent inflation and high interest rates. We're already seeing the early signs. Several supply chain experts and retail associations have warned that tariff-related cost hikes could hit just in time for the 2025 holiday season. Imagine paying 15–20% more for a laptop, a smartphone, or even household essentials. Not because of increased demand, but because of trade restrictions. And it won't just be tech. Clothing brands, automakers, construction material suppliers, and appliance makers are bracing for impact. Some companies may shift supply chains to countries like Vietnam or Mexico, but that takes time, and the short-term effect will still be higher consumer prices. From a financial planning standpoint, this is the moment to tighten your strategy. Start by auditing your monthly expenses, especially on goods that might be impacted by tariffs. Postpone non-essential purchases, build an emergency fund of at least 3–6 months of expenses, and focus on high-priority savings goals. If you own a small business or e-commerce brand that imports products or raw materials, now is the time to diversify suppliers or negotiate bulk purchases before tariff hikes go into effect. And let's talk about the markets. Tariffs often trigger volatility, especially if retaliatory tariffs come from China or Europe. That could spook Wall Street, lead to drops in tech stocks, or cause temporary panic in global indexes. If you're investing through a 401k, IRA, or a personal brokerage account, it's crucial to stay diversified and not overexposed to sectors reliant on international trade. Historically, trade wars have led to short-term dips but long-term recoveries, so don't panic sell, but do consider dollar-cost averaging into strong, diversified funds. Meanwhile, certain U.S. sectors like domestic manufacturing, steel, or agriculture might benefit from protectionist policies, but those gains typically take time to materialize and aren't guaranteed. What is guaranteed is that everyday Americans will feel short-term price increases, and households already struggling with debt, high rent, and job uncertainty will be hit the hardest. Lastly, don't forget the political risk. If Trump returns to office and aggressively enacts these tariffs, expect global trade tensions to escalate. That could impact fuel prices, foreign investment, and even the value of the U.S. dollar. In other words, this is bigger than just import taxes. It's a shift in the global economic order, and it affects your portfolio, your job market, and your long-term financial health. So here's what you can do right now. Reduce non-essential spending, pay off high-interest debt, avoid new big-ticket purchases that rely on imports, and diversify your income. Consider building a side hustle or learning an online skill that makes you more financially resilient. Because no matter who wins in 2025, the economy doesn't wait for politics to settle. If you found this breakdown helpful, hit that like button, subscribe to Scube Wealth Grid, and let us know in the comments, do you think tariffs help or hurt the average American? Let's stay ahead of the headlines and stay wealthy through the chaos.